Good morning, Wall Street winners. It is Thursday, April 3rd, and I just wanted to run through an example of a hedge strategy for you to hedge against corrections based on the craziness that we're experiencing with tariffs and the uncertainty, all the volatility that it's causing. So the volatility is not going to go away. So this is a strategy that you can implement as soon as today to take advantage of the volatility, knowing that markets go down and they go back up and they move around kind of like a roller coaster up and down. Typically, they continue to climb when you look at it over a multi-year period, but over a multi-month period in certain years, and I think we're in one of those multi-month periods now that started, say, mid-February, we're on a downward trajectory. So when you're on a downward trajectory, it's a bit of a mindset shift because most people are optimists and they want to see things going up. They believe companies are good, they use the products, they're happy with the brands, and they believe that those companies will appreciate in value. But right now, with all of the uncertainty introduced through the changes to the economy that are underway with the tariffs, things are on a downward spiral. And in that type of environment, it can be very beneficial to implement a put and call option. So yesterday, when the market closed, you can see the SPS or SPX, which is the representative of an index for the S&P 500, basically 10% of the value of that index. You can see that you can buy through your trading platform put or call options. So when the market goes up, as it did yesterday, it'd be a good idea to buy a put option, which is the option says that you believe that the market will go down, and you want to buy it close to where it finished. So it finished at 56.70 yesterday. So you might buy one at 5,600, maybe 5,620, maybe 5,500, whatever you're comfortable with. The lower the index rate that you purchase. So if I purchased one at 5,600, the cost of that put option would be more than the cost of one at 5,500 because there's a greater spread for it to cover. And if we take a look at what one of those options looks like, here it is. So yesterday I bought 15 put options on the SPS index, which is representative of the S&P 500, and I bought them at around $63.80. And now the markets, as we expected, have collapsed, and those options are now trading. You can see in this section here, they're now trading at between $181.80 and $188.90. And I'd expect these will get into the $200 range because I think the market is going to open up even lower than in the pre-market, and we're going to get some automated trading sell-offs, and it's just going to accelerate things into significant downward spiral. So right now, at what they're trading at, the priced gain is around 85%, and you can see that on the screen here. But as it actually trades at over 200, it's going to increase the gain to over 100%. And then you have to decide as the market goes down where you feel it's going to start to bottom out. And you could then look at selling all or even part of these. Maybe I sell off 5 at a time, and so that if it continues to go down, I can continue to profit. The flip side to that is if the market bottoms and it starts to go up, then I'm going to lose some of that potential additional profit. So you can determine whether you want to offload them all. I mean, these don't expire until the 17th of April, so I have until the 17th, but between now and the 17th, if the market corrects, then I'm not going to be in the money as much in these options because they change depending on the index and where the index is. At the same time, when you do find there's a bottom, or you feel you're close to the bottom, you could sell some or all of these put options, and you could buy a call option for whatever it is. So let's say that the SPX opened at, it drops down and bottoms around 5,300. You could then buy a call option saying that you think by April 17th or April 25th or whatever date you want in the future, that those options will, the index will get to 5,500 from 5,300. So it'll go up 200 points. And then if it does move towards that number that you chose, then that call option will appreciate. And that's how you can play the options market. in these super volatile times without risking a ton of your capital. So instead of putting a ton of money to work for you, you're putting a small percentage of your money to work for you, and you're getting a huge potential return on these with the big market swings. And that's how you can use them in your investing strategies and as part of your investing methodology. Hope you're enjoying the videos. If you are, would love to see you subscribe to the channel. Please like the video and leave me a like and a comment, and we'll talk to you again soon. Good luck.